Okay, so this is investments and financial planning. A financial plan is a comprehensive statement of an individual's long-term objectives for security and well-being, and a detailed savings and investing strategy for achieving those objectives. So basically it's saying you come up with a goal for what you want and what you want financially, and you're going to create a savings plan and an investing plan to help you reach that goal. That's what a financial plan is. The process of financial planning begins with a thorough evaluation of the individual's current financial state. So, important part is thorough evaluation. You're going to look into all of the person's finances and come up with a holistic view of what's going on. So we start with financial statement preparation and analysis to determine your personal financial position. And what that means is we're going to create for an individual person an income statement, a balance sheet, and a cash flow statement to determine their current net worth. So income statement, you would look at their sources of revenue. So what is their job? What do they have for expenses? So do they have to pay car payments? Are they paying what are they paying for groceries, all sorts of stuff like that, to get an idea of their net income. For their balance sheet, you're looking at their assets. Do they have a car? Do they have a home? Stuff like that. And then you're looking at their liabilities. So do they have a mortgage? Do they have other loans outstanding? Etc. And then for their cash flow statement, how much cash are they taking in each month or each period or each year? How much is going out? How much cash do they have on hand at any given time? And that helps us come up with an estimate for their current net worth. And that is the beginning of our financial planning process. After we've done that, we're going to review the information about the person's current state and then discuss future expectations. So the most important part is to have clearly defined goals. You really want to know what you're aiming for. So are you trying to save for an apartment? Are you trying to fund a college education? Are you looking to buy a house? Are you looking to retire at a certain age? All of this will affect how your savings and investing strategy is determined, so it's important to be upfront about what you want. And then you are also going to be creating a highly individualized plan, so it'll look different for every person depending on what your personal situation is, what your family situation is, what your risk tolerance is. That's obviously very important, what your values are. So everyone's plan will look different based on your goals and then your characteristics. And the end result is to come up with a financial plan that involves investments and savings, and then you continually refine it. So the most important part of this whole section is that this is a dynamic process, not a static process. So over time, you continually go in and evaluate what is working well, what's not working well. Have my goals changed? Do I want different things now? Am I more risk averse now? Was there some sort of family issue that happened? And what do I need to do to change my financial plan to make it meet my current goals? So dynamic is the key word here. So part of financial planning is coming up with an investments and savings strategy. And if you've taken investments or corporate finance or anything like that, this is all going to be very familiar to you, but I'm going to go over it anyway in case you're not familiar. So there are three main types of assets: stocks, bonds, and cash, and they have different purposes. So starting with stocks, stocks are for growth. So here we're looking at capital appreciation. And stocks have the highest rate of return because of this, but they also carry with it the highest risk. And we'll talk about risk versus return later. Bonds are for income, so they are steady streams of cash coming to you, and they provide a medium return, and with it comes medium risk. And obviously for bonds, there are a lot of different types. So there are safer government bonds, highly rated bonds, and then also some below investment grade bonds that do offer higher return but higher risk. But overall, bonds offer a medium return and come with the medium risk. And for cash's purpose is liquidity and stability. It offers no return if you're just holding on to it, and it also comes with the lowest risk because the only real risk is just the risk of inflation and your dollars or whatever your currency is losing value. So the last part on this slide is percent over time, and that's basically just that when you're younger and you are aiming to save and accumulate money, you want to have the highest percentage of your assets in stocks, and then bonds, and then cash, because stocks offer you capital appreciation and that's what you're going for. But then when you're older, you'd prefer to have more in bonds and cash because likely you're retired, you're not really looking for a lot of risk, and you are also trying to protect that income because you don't have a job anymore, you don't have other sources of income. So, alternative investments. In addition to stocks, bonds, and cash, there are numerous alternative investments such as real estate, hedge funds, private equity, venture capital, options, futures, commodities, and more than you can think of. And these are significantly more risky. For that reason, the average investor doesn't really get involved with these. You also need some qualifications to work with them, but these are just for you to know that they exist. Risk versus reward. So on the handout on Canvas, it says the greater the risk, the greater the reward required, which basically means that the rate of return is higher on riskier assets. So it's a trade-off, which I kind of hinted at earlier. If we look over here on the right, how markets perform, these are annualized returns by decade. But as you see, since 1926, stocks have delivered the highest returns, then bonds, then cash. Stocks are represented in the dark blue by the S&P 500, which is a collection of stocks in an index, and then in red we have intermediate term government bonds, and then in green we have treasury bills, which are the lowest risk type of bond, which is also a proxy for cash. And we see in every period stocks outperforming, then bonds, then cash, and that reflects the risk we talked about earlier with stocks having the highest risk, then bonds, then cash. How to deal with risk, we talk about diversification, which is a process of allocating capital in such a way that reduces exposure to any one particular asset or risk. So basically, the main idea is you reduce risk by investing in a variety of assets. And then the last part here, your risk tolerance is going to vary over time, and that could be due to just your age, like I just talked about. So when you're younger, you often invest in more risky assets because you have more time to recover if something goes wrong, and it's also the time to start building up funds. But when you're older, you are likely retired, you don't really have other sources of funds coming in, so you want to be more stable. Your goals could change, whether it be unexpected events in your life or just goals changing as you age, stuff like that. But main idea is that your risk tolerance varies over time. The rule of 72 is kind of an obscure topic, but basically the rule of 72 is a method that determines the number of years it takes to double an investment's value at a given rate of return. So what we're finding is the number of years it takes to double an investment's value. And the formula is number of years it takes to double investment equals 72 divided by the interest rate, and the interest rate is in whole number form. So an interest rate of 12% would be written as 12, not 0.12. So in the example, it says how long would it take to double your investment if the prevailing interest rate was 12%? So it would be 72 divided by 12 equals 6 years to double investment. And the purpose of this slide is just that, and the rule of 72 in general, is that it's important to start saving early because of the power of compounding interest. So obviously, if the interest rate was 12%, that is very high, but that shows you that in just 6 years, you would completely double your investment. So there's a real benefit to saving and starting to save early. Okay, and the last two topics are present value related. So the present value of a single payment. First of all, what is present value? Present value is the current value of a future sum of money or stream of cash flows, which we'll discuss next for annuities, given a specified interest rate. So present value can be calculated in two ways. The first is through this formula. So it's present value equals future value divided by 1 plus r to the n, where PV equals present value, FV equals future value or face value, r equals the interest rate as a decimal, and n equals the number of periods. So you can either use this formula or you can use below, which is a table of discount factors. And I'm going to show you an example on how you would use both of these down below. So if we create the example, you are receiving $1,000 in 3 years, and the prevailing interest rate at the time is 6%. There are two methods that you can use. So the first is the formula I just showed you. So you would do the formula, again, I'll just write it first. Present value equals future value divided by 1 plus r to the n. Present value would be the future value, so you're receiving $1,000 in the future, divided by 1 plus r, so 1 plus the interest rate. Interest rate is 6%, so 0.06, to the n, which is number of periods, so it's 3 years, so to the third. And if you do this calculation out, you get $839.62. The second way is using the table, and this is much easier. You don't really have to do anything out. You're just going to do the following. So we're going to look up here, and we're going to find the intersection of 3 years and a 6% interest rate. So we have the 6% interest rate and 3 periods, and that gets us this discount factor right here. And then all we are going to do is multiply the future value to be received, so $1,000, times that discount factor, so times 0.83962, and we get the same value we got before, so $839.62. So both of those get you the same present value. You can use either one. Yes, and that's present value of a single payment. The present value of an annuity is a little bit different. So an annuity is simply a series of payments made at equal intervals. So instead of it being a single payment, now it's you're receiving multiple payments. And there is a formula for an annuity factor, but you absolutely don't need to know it for this course. You'll learn it in corporate finance, so I'm not going to show it to you here. I'm just going to show you an example using the table. So we are going to do the following example. We are receiving $100 per year for 5 years at 5% interest. And when you're doing the calculation for an annuity, the value you're multiplying by is the value that you receive in a single payment. So in this case, it would be the $100 that you're receiving every year. And then you're going to find your annuity factor doing the same process. So it is 5 periods and 5%. So it is 4.32948. So we multiply it here, 4.32948, and that gets us $432.95 as the present value of $100 per year for 5 years at 5% interest. And that is all I have for you. If you have any questions, feel free to follow up with me. I hope you have a great rest of your day.